Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions on whatever we're seeing. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's just dive right in, take a look, see what people are sharing. If you want to follow me at @Finance, if you want to join our community, finding-value.com. We've got two major things in the community that I share each week. I do a midweek update, which I share my opinions on individual companies, all the charts and things that I've listened to and conference calls and stuff like that. We have Q&A sessions, question and answer sessions on the weekend, either on Saturday or on Sunday. Saturday is a 7 a.m. Mountain Time. Sunday is a 5 p.m. Mountain Time. And we alternate between those two to capture the most amount of people who can make it. That's where I dive deeper into anything that you guys want me to dive into. We talk about conference calls of individual companies that we're following that I think are of good value and good entries. We talk about technical setups. We've done technical analysis training. We've done a whole bunch of different things. We also talk about fundamentals. We talk about high cost, low cost producers, the Lassonde curve, on and on and on and on. We talk about market fundamentals, oil, uranium, fundamentals of whatever people want me to cover. So if that sounds interesting to you, special is the coupon code if you like to join. And it's 50% off the first month only, and a larger discount on the yearly membership. So Tavi's talking about Brazilian stocks. A major breakout is in the making in his view, and I completely agree with that. Markets are just starting to wake up to the idea that Latin America could be among the biggest beneficiaries of ongoing global trade realignments. It's worth emphasizing by nearly every fundamental metric, Brazilian equities are currently trading near historical lows in valuation. And this is the big squeeze. This squeeze is exactly like all of the commodity companies' charts and the commodities uh, like currencies against the United States dollar. It even looks the same as platinum. I mean, this is the same exact movement as platinum's got going on. All of these are going to break at the same time. And the driver is the dollar. So the dollar is going to be the driver of this big move in commodities and in emerging markets. They're all going to be synced together. And the weakness in the dollar is going to be that driver. So watch the value of the driver. Some of these companies are highly leveraged to currency movements. They earn in real and they've borrowed in dollars. They get crushed on the downside when the dollar is outperforming the real. They do absolutely incredible things when the real goes up against the dollar. Some of these companies, at least historically, have gone up 30, 40, 50, 60, 70 times, depending on the company that you are looking at and the sector that you're in. Obviously, that's from bottom to top. Realizing that amount of return is difficult, but if you can get 10, 20, 30x out of it, you got the lion's share of that move. We are very early in this move, as you can see in the Brazilian stock not breaking its downtrend. So those opportunities are still abundant at this time. But if you wait a long time, they will start to pass. I will say that. Here's rock bottom entries. I want to read this and I'll see if I agree with it or not. He says, a game-changing tip for better positioning and risk management. Picture this. You found an investment or trade that feels like a home run. The story behind it is compelling. The chart is screaming buy and you're ready to dive in. But here's the catch. Don't, not yet. Take a deep breath and pause. Resist the urge to pile in with reckless enthusiasm. Most opportunities don't vanish in a day, so give yourself the gift of time to think with a clear head. This simple act of restraint can save you from costly mistakes. Here's the real tip that will transform your approach to trades at least. Before you click buy, imagine you've already entered the position and the price immediately tanks. How do you feel? What's your next move? If your gut reaction is panic, doubt, or second guessing your entry, that's a red flag. It signals you might not be as confident in the fundamentals or technical setup as you thought. Maybe the story isn't as airtight, or the chart isn't at the inflection point you assumed. It's time to step back and reassess. Now, if it's truly a great buy, a moment where the fundamentals align with the textbook chart setup, your reaction should be different. You should feel calm, unshaken, and confident that your trade remains valid, even if the price wiggles against you. A true edge in the market doesn't crumble at the first sign of adversity. So here's your new pre trade ritual. Every time you're about to open a position, mentally stress test it. Picture the price moving against you and gauge your emotional and strategic response. This simple exercise will reveal how prepared you are to manage the trade and whether it's worth taking at all. Master this, and you'll not only trade with more confidence, but also sidestep the emotional traps that derail most investors. Well, I'm going to share my opinions on this. I think that things are getting more difficult to trade on a technical basis. The reason I say that is I see a lot more false breakdowns occur quite a bit. I also see things that squeeze into patterns and they're more sloppy than what they used to be. It seems like everyone using technical analysis has distorted to some degree these charts. And I'm not saying you can't use them, but technical analysis is really only a tool to validate a opinion. What people are doing is they're using technical analysis for everything. They're using it to determine everything about everything. They don't know anything about the company. They don't know that much about the sector. That's what gives me the confidence. It's knowing the company, the CEO, the earnings conference calls, and then knowing a lot about the sector. And I'll give you one example of a potential setup that I see in the markets right this second. So when I look at this, and in here, he didn't mention really much about the fundamentals. He did say that there's a fundamental and technical alignment, and that's exactly what I look for too. But what I want to see is I want to see that the market is pricing something wrong, so it's vastly undervalued. And then what I want to see is I want to see that the setup is there. What does that mean? I want the setup in the sector to be undeniable. So, for instance, right now, we have a ridiculous setup in natural gas. It is ridiculous. We've got LNG terminals that are being built coming online. We've got switching from coal to nat gas and electricity. We've got renewables that are leaning on more natural gas to cover the shortfalls. And we don't have any sort of electrical storage. We've got a wall of demand of electricity coming through a variety of things like artificial intelligence, electric vehicles. And we've got nothing between now and perhaps 10 years out that will stop natural gas from doing it. So when I see that, and I see that our inventory levels in terms of days of coverage are low, and you look out there and you say, holy crap, there's going to be a freaking gap. There's going to be a gap in supply and demand. Prices are going to have to rise. So then you use the charts to see if what you are thinking is correct. Then you keep tracking the fundamentals of it. If you botch an entry point using technicals, you always can fall back on your valuation. Because if you're purchasing companies that are undervalued, well, then you can just wait it out. You don't have to be right on the technicals. And that's where a lot of these people are wrong, in my opinion, is because they're too focused on the technicals and not enough on the fundamentals. They try to get really good at the technicals. And some people will say, oh, well, I tried the fundamental approach. It's about getting the alignment between all of it. So he's right on that perspective. Now, If you know what's coming in the sector and insiders are telling you that they're actively building stuff for X, Y, or Z, does that increase your chances of being successful? The insiders are saying, look, this is what's coming. We are positioning for it. And then you look at the technicals, and the technicals are showing you that this alignment is coming. And you buy a ridiculously underpriced business for this position, for this setup in the market. It doesn't mean that you win in the short term. You can't perfectly time bottoms. It's impossible. So at some point, more than likely, you will be down on that position. More than likely. And I don't know if it's a single digit percent or maybe even multiple digit. You might be down on it 30% or 40%, even though you tried your best with the technicals to get a great entry point. The question is, what are you going to do? Are you going to buy more? Maybe your strategy is to cost average into the position and maybe not go all in at once. There's all these different strategies that you might want to think about when you invest. It's not about one thing or the other. It's not going all in, trying to use technicals to get the absolute bottom. And I see it, almost everyone's trying to do that. They're all trying to just dump it all in one spot, and they're trying to get the bottom. And a lot of the times it doesn't work because technicals are not 100% accurate. You might be working with something that's 50, 60% if you are reading the charts very well. It gives you a slight advantage, but you're wrong 40% of the time or more. Because once you position, the technicals may only be good for, a short-term little trade. And Elliott wave and other technical patterns get distorted. And that's the entire reason I added two more things to technical analysis, the two pillars on top of it. So there's three pillars: technical analysis, ratios, and market cycles. Ratios are kind of your fundamental cycle analysis, and you can throw fundamentals in there too, because that's really what drives the cycles. So if you know your cycles, you know that you're underinvested, you have a cheap ratio, the technicals are starting to look good, you still have to go through a bunch of crap, the way that investing is. Even if it's already had a 50%, 60% pullback, even if you're buying a fib retracement at 0.618, even if you're doing absolutely all of it combined, you get a double bottom, fib retracement, 0.618, and you still have to go down 6, 7, 8, 9, 10%. Because these things move so quickly. But at least you're not down 90% chasing and buying at the top. So I agree with a lot of this, but that's kind of my approach there. We'll talk about buying bottoms and what I do and why I'm so bullish on things. And really what it is I'm just stacking information. I might stack 10 pieces of information. And if things start to look good and the majority of these 10 pieces of information, it's go time to me. Because you're never going to have the certainty. If you wait for certainty, it is too late. Coming down, Baker Hughes rig count for week ending 5/2/2025. U.S. oil rigs is down 4 to 479, and U.S. gas rigs are up 2 to 101. Look at this. Both of these are down. Now, for a lot of people, that doesn't mean anything. Oh, what's that mean, Andy? It doesn't mean anything. But it does mean something. Why does it mean something? This is something that you don't read in books. You just figure it out. I mean, that's the way that I view things. Like, no one taught me this stuff. It's like, okay, if I was a drilling company and I provided rigs to both oil and natural gas, you've gone down in both of these. But both of them are down and they look like they're trying to bottom here. So what can one think about or talk about? Well, the drilling companies, if they both have rigs against US oil and gas, and these are both down, they could both go up together too at some point. Yes, and if they both go up, what does that mean? It means that the current situation that we are in could be a potential bottom, and it also means that when they both go up together, we would see a twofold increase because demand for rigs would go up both for oil and gas. I think at some point in the near future, we are going to see a sea of demand for rigs to go up. Maybe not this exact second. Maybe we are down and there is a lot of fear in the market about potential recessions and stuff like that. That's exactly what we want to see. And this is data backing some of my opinions. But that doesn't mean that we've hit the ultimate bottom. Maybe there's one last little wiggle before we move on up. That's definitely possible. And that's what you need to get ready for, those types of wiggles. And this is stacking information on top of each other. The TSX Venture confirms a multi-year base breakout. Junior resource bull markets in full swing, shoulder, head, shoulder, and we're starting to break out with a rising relative strength. And you can see we're above the volume base too. So your volume, when you're above the volume bases, it acts as support. When you're below these big volume bases, that's where you get a little bit of resistance. I got some quotes here. I didn't really see a bunch of people sharing a lot of cool stuff, so I'm going to share some quotes. So investment strategy and value investing. A value strategy is of little use to the impatient investor since it usually takes time to pay off. And you know what everyone's looking for? They want people to tell them they've got the secret. They're searching for the secret where they make money in a very short period of time. I hate to say it, but I hate to tell this to most people, but a lot of the times it's a buy and hold strategy for value, and that's the way it works, and it takes time. In investing, what is comfortable is rarely profitable, and that's with certainty. Oh, I'm certain this will go up, and then you look backwards and something's up 100%, and that's what everybody goes into. The problem is that's already had the move. You want to buy when things are uncomfortable and uncertain, and that's how you buy bottoms. Once you adopt a value investment strategy, any other investment behavior starts to seem like gambling. And it's true because that's kind of how I view things. If it doesn't make money, you're kind of just gambling. It's a ticking time bomb before the next dilution. When you look at just doing technical analysis, you're like, well, why aren't you looking at the fundamentals? There's no value here. Once you adopt value investment strategy, everything else and all those investment behaviors start to look like gambling. Totally true. Coming out, I got some more quotes here. So investment errors. It says the biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. And I don't know how people can master this unless they are well aware of what they are doing. A lot of the times people, this is what I've observed with a lot of people. They get afraid of two things. They get afraid of the price going down, just going down. And what they view in their head is, I am losing money. And there's a psychological response, genetic response, that they want to extinguish this loss out of their account. A very good investor takes advantage of those people and buys the shares from them. So what happens is they call that an emotional investor. The emotional investor looks at their account and sells based off of the price going down. It has nothing to do with the business, nothing to do with the fundamentals, absolutely nothing but price going down, I'm losing money. That's all they can see, that's all they can feel, get it out of my account. And that is one of the biggest investing errors. Here's another one. By refusing to pay too much for an investment, you minimize the chances that your wealth will ever disappear or suddenly be destroyed. And that's Ben Graham, and that's the value approach. So if you always avoid overvalued assets, you reduce the chances of getting caught in gigantic pullbacks. It doesn't mean that you won't be in a company that became overvalued at some point in its life, and it doesn't mean that you have to sell it. But what it does is it prevents you from taking entry points into things that don't have any value or things that are grossly overvalued. And that's where it keeps everything in your portfolio, quote, in cycle that you're buying. Because if all you're doing is going around looking for undervaluation and all you do is buy undervaluation, you would be looking at different companies today than you did back in 2009 and 10. And that keeps you in cycle as well. So valuation, buying valuation, I should say buying undervaluation, keeps you in cycle and it keeps you out of cycle for the ones that are that are leaving its cycle because those are all overvalued. Here's a couple more, and this is the last quotes here. So this is Howard Marks on risk. He says, here's the key to understanding risk. It's largely a matter of opinion. um, some people say, well, how risky is this investment? It's largely a matter of opinion. I view risk as the ability for the company to put money in my pocket, or even the ability for the company to make shareholder returns, or the ability for the company to put money back in their own pocket to sustain the company and the operations. If they can't do that, that is risky. It's risky if they can't do that. That means that they're probably going to have to borrow money or they're going to dilute you. And I don't like being diluted. Coming down, investment success doesn't come from buying good things, but rather from buying things well, just buying things undervalued. It's the same quote as the one before, where you want to buy things that are undervalued. Success comes from buying things that are undervalued. That's all it is. And then investment risk comes primarily from too high of prices. And too high of prices often comes from excessive optimism and inadequate skepticism and risk aversion. And that's where the certainty and uncertainty comes into play too. So you're buying an overvalued item because the price went up. That's the only reason that people are buying things. They're chasing with their emotions. That is risky. Investment risk comes from buying things that are too high in price. They're overvalued. There's too much optimism, inadequate skepticism, and risk aversion. Conversely, the best time to buy a stock is when the risk is the least and the upside is the most. That's the risk reward or asymmetry. And precisely when the risk is the least is when everyone is the most fearful to buy it. How does one master their emotions to buy when everyone is so fearful and when the risk is the least? Think about that for a long, hard time. Think about how you buy stocks. Think about how you approach in your strategies. I mean, just think about this for a second then. If you didn't know anything about the company at all, and all you're doing is you're buying a breakout of a downtrend line or a horizontal line that's starting to break higher, why do you think that's a good investment? Does it take anything into account about the risk that that company has? No, there's absolutely nothing in it. What's the value of the company? Oh, I don't know. What's their earnings? I don't know. What was their last conference call? I don't know. You really don't know any of that? Conversely, if something goes down and it's way undervalued, but all the charts are telling you that it still looks like crap, why would you sell it? All you have to do is wait. Maybe the charts will, I'll say, look better with time. And then you start buying more of it and more of it and more of it because it's undervalued and a good opportunity. Value investing takes patience. That's what all these, the best guys say here. So when I start looking at things and when I see other people's approaches, all they do is they say, well, this has broken the trend line. And it's like, okay, that's one step. What's the value on this thing? I don't know. That to me is risk. That screams risk to me. That they're not properly, adequately handling the risk of the company and what their valuations that they are buying at. That's what I view as risky. Here's Robert Friedland. He says Morgan Stanley on copper. The physical copper market looks tight. In China, inventories are drawing rapidly, and the Yangshan premium is rising. Both LME and Shanghai copper are in backwardation, and treatment charges are turning even more negative, suggesting challenges in sourcing copper concentrate. After a slow start to the year, China's copper import demand appears to be improving. This can be seen in rising physical premiums. The Yangshan premium is now $93 a ton, the highest since late of 23. A rebound in refined copper imports in March, they're plus 12%, and challenges securing scrap metal, which are translating into even lower treatment charges at smelters as they compete to secure copper concentrate. So copper market's getting tight, says Robert Friedland over in China. Rock Bottom Entry says agricultural commodities and related stocks are firing bullish signals everywhere. A fresh and powerful cycle has begun. This weekend's Substack report will dive deep into the sector, presenting a clear and compelling case. RBE's top investment theme and highest conviction call. And I've actually been buying the fertilizers here. And there are two fertilizers companies that I prefer because of the asymmetry that they have. Last commodity bull market, and we're early in this bull market, guys. We are still very, very early. Last commodity bull market, I watched a few companies in fertilizers go up massively. I mean, massively. Many, many, many fold, 20, 30x or more. I am in what I think are the best companies for that to repeat again. Got my few favorites. And I do think that this is probably already bottomed and it's heading higher for some of the companies. And we're just coming off that bottom right now in fertilizers. So now's the time to be looking. And usually people are the least interested when you should be the most interested, and they are the most interested when you should be the least interested. I will go over those companies. Some of you guys, I know you're already buying them that are part of the community. Um, we've seen a pretty big move off that bottom already on one of them, a good 20, 30% higher. But I still think it's really good, and I think we've got a long way to go. And I'm taking this from the big long-term view, guys. These are companies that are gonna build uh, projects out for transportation too. So I mean, there's some really good opportunities. David Burrows says, put your bias aside. European stocks are in a new bull market led by financials and defense. The carry trade has begun to unwind, and this is MSCI Eurozone ETF breaking out of this consolidation. That consolidation was from 2009 to 2005, or sorry, 2025. This year is also a function of a weaker dollar. And all of these things are going to start to break. You're going to see the Brazilian ETF that we were looking at up above. That will break. This will break. Currencies will start to break. Everything will start moving. That's when I saw craziness last bull market. We are still very early. And what I mean by craziness, guys, I don't think people can, like, it doesn't register with them because a lot of people have never experienced it. When things go up, they're going to go up like 3%, 4%, 3%, 4%, 3%. It's like it just keeps going up and up and up. And then you get a down day, like you're down 1, 2%. And then it just keeps going and going and going and going. And it goes like that for 3, 4, 5, 6, 7, 8 years, where it just goes and goes. Your compounded annual return, and I ran the numbers looking backwards. I set up portfolios that I just randomly threw together. I didn't do it any rhyme or reason. I just wanted to say, I'll throw a couple of these in, a couple of this in. And I had 3 or 4 portfolios that I tested against different strategies and approaches. The compounded annual return during the bull market was 54% compounded annually for 10 years. 10 years. 54%. It beats almost everyone. And it deals with the strategy. It deals with how you set the portfolio up, your allocation, and your asymmetry. But you have to be disciplined. You have to have an approach and a strategy and stick to the strategy and have certain portfolio allocations. And the returns, even if the top 5 returns were removed from the portfolio completely, put to zero, you still got 30+% annual returns, compounded annually. Crazy. I know, it's crazy. Lynn Alden says China exports 3.5 trillion per year. U.S. imports from China is about 500 billion a year. This is their import or their exports over time. That's pretty crazy, to be honest. And here is your United States import from China. It's not all that much going on here lately. About 500 billion to be exact. Baker Hughes rig count, we're down 4 for oil, up 2 for gas. I think we talked about that above. Key OPEC nations are discussing making another production increase of roughly 400,000 barrels a day in June, ahead of a video conference to set policy on Saturday, delegates said. This should rather say KSA is adding 400,000 barrels per day. Everyone else is cheating anyway. We'll see what happens here. I don't know if this is like legit news or if they're floating these things out trying to get the price of oil down. We have experienced before fake news, both in silver and gold and in oil. I've seen it. And there's been later things that have come out saying that the government paid certain areas to create this fake news and release it. So I don't know if this is real or not, but we'll see. Even so, 400,000 barrels, I think the market will soak that up pretty easy. And I think that's probably why if they do add it, I don't know if it's that really big. I don't know if that's big of a deal. We're probably going to lose 400,000 barrels at this pricing from the Permian, probably, or from America, U.S. shale. Because when it comes to long-term investing, doing less is often more. Joel Greenblatt, and I agree. Sitting on your hands doing nothing, being patient, getting the right companies, get roughly at the right time. Try your best to time it as best you can, and that's all you can do. And you sit and wait. Here's the uranium spot price. So this is uranium. You can see the bearish side and then the bullish side. That's what I created. And then you can see that we've been coming on up. So I think uranium looks great. I think it looks fantastic. Here's Saudi Arabia. Oil production drops to the lowest level in 15 years. We're at about 9 million barrels. And the highest this has ever gotten is about 10 and a half. But somehow they can produce 12. I'm like, where's 12? This is off the chart at 12. I don't even think they can do 11 million barrels up here. I think they can do 10, maybe 10 and a half for a period of time. That's it. But if they're at 9, that means that world spare capacity is about 1.5 to 2 million barrels. That's it. Everyone else is cheating, guys. They're not held down. They are pumping at full capacity. This is going to get so interesting in a couple of years. It's going to be insane. Because if we eat through this spare capacity, we're at pumping capacity. I mean, you're just going to see the price go up, 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 and up. And I don't know what the heck's going to stop that price move. Like, I don't know what will stop it. Yes, it will stop because it will kill demand, but like, I don't know what will reverse it permanently. So we could go into recession, the price could fall, but that doesn't mean that we'll necessarily produce more oil on from 103 million or 104 million barrels per day to 110. Like, I don't know how we get to the 110 or 120. I can see a lot of problem areas where things peak out and start to roll over. And when they roll over, it's going to be harder and harder just to keep and hold production where we're at. So I think it's going to be interesting a couple years out. The chaos is brewing and happening right now is abnormal. It says Japan's threatening to dump United States treasuries if the U.S. doesn't stop the tariff threats, which makes sense because the world recycling their USD trade surplus into USD bonds was the OG tariffs. Trump is probably going to resume pressuring Powell to cut rates before inflation blows up later this year. The Ukraine situation is unresolved, and tariffs on China is going to backfire soon. Trump and Bissett had a good plan on paper, but they forgot that plans on paper don't hit back. In reality, everyone hits back. Here's Kevin. Kevin says Bitcoin solves. Okay, I think I already talked about this one already. Pretty sure I did. Yeah, I think we did. So I'm going to stop it there. Give me a thumb up for the content, guys. Subscribe to the channel. Subscribe to the website if you'd like. Don't forget, we've got that Sunday question and answer session coming up. So love to see you guys there. Ask whatever questions you want. Make things interesting, and I'll share whatever I know about the markets and kind of what I'm doing. We are going to go over my approach buying bottoms and what I look at and how I do it. Um, we'll use some real world examples, real time, and then I'll show you some other things that I look at. And there are things that I notice that make me get real bullish at what I try to find at really low prices. And that is what I continue to refine is my approach to buying bottoms. It's very difficult to do. Doesn't mean I get it right all the time either. But there are some strategies that you can deploy as well, where you can minimize some of the downside um, by not going in 100%. I'll just say that. And we'll talk about all that this weekend. So special coupon code if you'd like to sign up. And that's all I've got for today. So we'll catch you next time, guys. See ya.